software.
It is. It is. And we're live. We're live. So, hey, all right. Hey, everybody, I'm live here, and I'm bringing you some serious mortgage knowledge today. I brought in, as we call him, KP from PRMG. He's our Chief Lending Officer, and he has a wealth of knowledge. And if you watch LinkedIn at all, you've probably seen him pop into your feed as he does a daily probably at 2 a.m. every day. A daily video that he does that is on what's going on in the economy, what's going on in the mortgage markets, just bringing a lot of knowledge to a lot of people and sharing a lot of information on all levels. So I thought it would be great to bring you on, talk a little bit about what's going on in the market, kind of how we're looking to grow our area, and just touch in on that. I mean, I like how you open all of your videos as live from Corona, California. That's right where you're at.
We're here. We're live. Actually, we are actually live.
Yeah.
I know it's funny. I always say that, but this is a true live feed you're doing. And who would have thought we'd be headquartered in a city named Corona after that virus?
Yeah, exactly. I mean, it is, and it's been a crazy time, and we've seen a lot of movement in our market with the mortgages. And when Corona first hit, there was, panic stricken in our market. Rates were going a little crazy. The refis were nuts. We saw rates spike way up one day, way down the next day. And we've just seen it steadily now been going lower. And I hear a lot of people always asking me, hey, how much lower is it going to go? A lot of people sitting on the fence. And I've been bringing some advice. Some of the stuff I learned from you have been straight out there. I mean, what's your take on where we're going right now and how today looks?
Yeah. Part of why, I started doing these videos is because I was getting a lot of questions like this. We're growing as a company. We're, almost 2,500 employees, 1,100 loan officers. And especially in March when everything was so crazy, people would look at their rate sheets like, what the heck's going on, And then, of course, borrowers are calling in saying, I want that 0%, mortgage that the Fed is offering, So we're just, what's going on with the pandemic. And, we have a very experienced, capital markets team. Gary Malice and his team they're brilliant, and they really help shepherd us through this. They went through a similar situation in 2008, in which I was a part of their team together with them back in 2007 at First Magnus. So really good team, strong team, and we don't mind sharing the knowledge with everybody. Our borrowers are asking us all these questions. So what's going to happen with rates? I'll say this: there's two things I hear all the time. I hear the borrowers say this all the time. I'm waiting for the prices to drop. I'm waiting for home prices to come down. I was like, when the rates came down to the lowest level in the history of history, that was your price drop. So the home price staying the same, but the payment decreased tremendously. That was it. That was your price drop. So people keep thinking about, there's going to be a crash or in a recession, home prices have got to come back down to earth. That might happen. Maybe in like San Francisco and New York, because people are moving out because they're so densely populated, and the virus, the pandemic really hurt them. Maybe it's not worth paying so much or renting or whatever. So people are moving out of there, and home prices are coming down. Those cities are taxing. When you look at New York, they're taxing anything over $1 million. So they're just basically driving people out. But most other major MSAs markets, they're not having any price decreasing. In fact, we had a housing shortage. We have a supply issue before the pandemic. And so now we have an oversupply of interest rate and cash and money. So, that's one question here all the time. I'm waiting for a price drop. In most markets, you could probably say there isn't going to be one. Do not miss the boat. So
no, we haven't seen that.
and I think the other question we get a lot is what's going to happen with mortgage rates. And so I've only been in the business since 2001. I'm 44. I started as a wholesale account executive, and then worked my way into having my own lender and running a region, and running multiple channels. And then for 3 years had my own lender, sold and serviced loans to Fannie Mae, and then now we're here. I've been here about 10 years and love it here. One of the partners here, got my hands in everything. All of our originators are faced the same question. Whether it's a retail teammate like you or someone from the other TPO channels, what's going to happen with rates? And our borrowers ask that all the time. So, I like to, I do a little bit of contrarian thought. I like to say, well, what's going to make them lower? What's there to drive rates lower? I mean, typically when the Fed is pumping money and buying mortgage-backed securities, which they're doing at absolute record levels. I mean, they're over $1 trillion since March of buying, mortgage-backed securities, which directly affects our rates. The recession, we've seen the worst of unemployment. So we're gaining jobs every month and less jobs are being lost. So the employment situation is getting better. The economy is generally getting better. The election is about 40 days away. So we're going to have certainty with the president. People are saving and now spending. Retail spending is on the rise. What is it that's going to make the economy worse to make rates lower? And there are some answers to that question. There could be some the delinquencies because of forbearance could cost some lenders some money, but it's pretty much modeled out and people have a pretty firm control of what it's going to be like. I don't see it as big an issue as people think. Will there be foreclosures because of people going to forbearance? Yeah, the first people that, the 12 months of free forbearance payments that are done, it's in April and May of next year. Then if they can't just simply restart making their old payment, not pay back the rest that they owe, just simply start from there. If they can't do that, then they would start the foreclosure process, which, in states like, Massachusetts and New York, California could take up to 3 years. In, states with more common sense, you're not making your payment, let's move along here, like Texas, it's 90 days, the foreclosure process. So, it's not like this glut of foreclosures is going to come on all these markets en masse. People keep thinking about 08 and we don't have a broken financial system. We don't have a broken housing system. I don't see how rates can get much better than they are now without, tremendous more stimulus from the government. And I don't see that. So I think they've already started to get worse with the FHFA putting that 50 basis points in every single refinance for Fannie and Freddie. That just made all refinances worse by a quarter rate. There'll be other catalysts coming, improving employment, less Fed stimulus. Maybe the government puts in their stimulus and there's more money in the economy, jobs coming back, president election. I mean, I just don't see how rates can get much lower than they are now. I just don't see the catalyst.
Yeah, we've been pushing that out. A lot of people don't understand what that FHA that fee is basically. We call it a mortgage tax, pretty much, just a quick money grab.
It is, yeah. So for those that are listening that are on the front lines, or even your consumers that are listening, the FHFA is a regulator that was created out of the Dodd-Frank Act, and they oversee Fannie Mae and Freddie Mac, and they have imposed the 50 basis point tax. Now they're saying they need to raise $6 billion for the damages that are coming because of borrowers that ask for forbearance per the CARES Act. Then I heard the number now is up to 10 billion. And then they're kind of not even saying, well, it's really about that. It's just about raising money for Fannie and Freddie. And so the idea is to strip that money out of consumers' equity in their refinances instead of giving it to them. The FHFA has mandated that Fannie and Freddie impose that fee, so rates go up. It's like main tax, gasoline tax, cigarette tax. It gets passed on. And so as of right now, our government and the regulators at FHFA, have decided that the best use of our borrowers' equity and their taxpayer dollars is not to let the Fed stimulus benefit them that 50 basis points, but rather them, so they could strip it out and then set it aside in a big old savings account, and then try and privatize Fannie and Freddie, which I think is a bad idea as well. I mean, when everything hit the fan in March, all these private companies, they just stopped lending. Literally, everyone just stopped lending and just kind of like puckered up. And so, anyway, it is a tax. It's an assessment. And it's not to say that the FHFA and Fannie and Freddie don't do tremendous goodwill for housing. I mean, they are the backstop of the housing industry. We just think this is a bad policy, and it's going to make rates go up. I mean, rates are going up for refinances for sure.
Yeah, we've seen it. I mean, I've seen it on a few that were on the fence, kind of waiting around, and now they're jumping on quickly.
Yeah,
because I've been able to show it to them, and they see the numbers. And
you see, we put it on our 60-day lock only.
Mm-hmm.
last Monday. And then the idea is next Monday, put on our 45-day lock is still the plan. And yeah, I mean, that's it. I mean, we got to move. I mean, we got to get these things locked and moved along. These loans have to be delivered to Fannie and Freddie December 1st. So they need to fund, I mean, for us, at least a week early if we're going to sell it to the cash window to either one. So, yeah, we 45 days from now, you're right about that. You're starting to get around that time. So, yeah, get those loans locked, get these bars off the fence. You know, rates are going up.
Yep. That's kind of the mantra I've been telling them. And, a lot of information that you've been pushing out there for us to be able to utilize and tell our clients and tell everybody on the street, this is where we're going. This is what's happening. And this isn't forever. This isn't something that's just going to be the new norm, that rates are always going to be 2%, 2.1, 2.2. You're not going to see that forever. And so if you want this opportunity, now's your chance.
We might see that 50 basis points forever.
Yeah.
The third thing is, we don't know when they're going to take it back. I mean, the way this regulator acts is they don't have to ask us for permission or do anything. They're just doing their own thing. And, we have to go to Congress and get both parties to fight back just to get it to delay. It's supposed to roll out in September. We got them to delay it until December 1st. They haven't said when they're rolling it back. The last time there was an adverse market fee for 25 basis points only, after a real recession in 2008, where there was a true broken financial system and broken housing system, that thing stuck on the rate sheet for 4 years.
Yeah.
And the only reason they removed it after 4 years, because they've been raising the guarantee fees, the G fees that are inside loans now, that entire time since the last crash. And so they made it a permanent thing by raising the G fees and then moved it away. So now, if they're going to take the same playbook, I don't know. I mean, it's not like they're sitting there with like a ticker going, okay, we got our $6 billion, we're going to remove it now. I mean,
no,
is that, so it's just that may be there forever, and that's pretty crushing blow considering, where refinances are going, in this Amazon effect type world. Consumers are looking for cheaper, better, and faster, and they get it with you, but they get it less with all of us when there's 50 basis points in every single refinance, for a Fannie and Freddie conforming loan going forward.
Oh, I know. That's the thing is that, we all play in the same sandbox. So we all have to deal with that, all of us lenders. And, makes us stand apart is trying to give you the full digital experience with still being able to get face to face with somebody. I always tell people, the rocket's in space, I'm in your face. So try to make it, you still get my personal, but you can still have all the tools. And so, we have to set ourselves apart, be able to give the best service and very, very strong pricing, which puts our margins thin. But so we got to be able to get, make these things happen. And then the more of these things add on, our part in bringing people like you out to the public is so people can kind of understand what's behind the scenes sometimes when it comes to pricing a loan out and figuring out, why rates are moving up, what's going on, why rates are moving down, what's going on, kind of what's going on with the market. I mean, because Corona's had a big impact, with the general economy. And then, with these extra fees that have popped up, that's just, those are things that have hurt us. And it's not panic time, I don't think, but it's definitely something I think people need to be aware of as we move into this area and so they know where we're going.
Well, I love, that you said that, you're in their face, there you are, you're in your community. Look at the background, you're more experienced than any, little monkey you're going to get on a headset in Detroit over at Rocket. You're building the community. And so you have experience. You are over your own processing team, underwriting. You have the ability to control that process and help people with purchase leads. So, look, I mean, Rocket's a great company. They started, from private beginnings. I've heard stories about Dan Gilbert personally involved in loans and stuff like that. And now they get 1 out of 10 loans, and then they said they want to get 1 out of 4. So, who's going out of business? If they're going to get 25% market share, someone's going out of business.
Yeah.
or doing considerably less business. It's not going to be us, right? So, we're going to continue, to fight on the local level and win local. There's an abundance of business to go around. I mean, iron sharpens iron. They're forcing everybody to step their game up. And, again, we have you. You're right there in the community, helping build the community and literally talking to your clients who are around you. You have that local knowledge because you lived it, you feel it, you know that area. And I think that if you can be cheaper, better, and faster, and be local, that's ultimately way better. So I think that's a winning combination for you.
Yeah, I think that's where we're gonna win, and what we're building, and what we're trying to grow. And I know you got a hard stop in about 2 minutes, so
we'll make it 5. They can wait.
So I mean, because that's as we talk about that, that's the things that we're trying to do for. So some people have asked me, hey, what's your plans? What are you guys gonna do? And like you were saying, I'm in control of my own processing, my own underwriting. We've got our closers, so we're gonna be having we have our control, and that's one of the biggest pieces in lending that you need to be successful. So you got to have control. If you don't have control and you're beholden to a centralized system, you can have a great time for a little while, and then but if a certain area gets busy, you suffer. So when you control your own area, you can make things happen. And that's one of the things that attracted me to come over to build this area, because North Florida doesn't have the presence yet. And so our opportunity now is to bring in the loan officers. We're building the ops team. And so we have the ability to build this phenomenal system here, because I'm seeing it now, how it's working in South Florida. They just got an award for best place to work at. I've seen how their ops teams are flying. And so we're just duplicating that exact system right up here. And it's in growth mode right now. It's exciting. And
no, it is. You're touching on all the fine points. I met Paul and Robert, the two founders, Paul Rosso and Robert Holiday, about 10 years ago, and we just celebrated its 19th year in existence. And when I met them, I love the way they we have a saying here, built by originators for originators.
Yeah.
So the originator is the local expert. They are the professional, and if we build what works best around them, then all else will fall into line. Your realtors, your borrowers, your builders, your teammates, your community, everything else will be served because we trust you. And that decentralized fulfillment model is a winner. There are some really large parts of the market where you can be centralized and have an assembly line and do everything by computer and not talk to anyone. That's fine. They're going to get that market. Like, that's okay. We don't have to be number one like Rocket wants to be, but we want to be best at serving our community. And that means serving the first-time home buyer first and foremost, and then that family's needs as they evolve over time. So being decentralized, having decentralized fulfillment was one of the first things that brought me to this company. Mm-hmm. So that entire team, it's there on the East Coast. That's all my old people. That's me being out there. So and it was awesome. It is good that Paul and Robert, fostered this environment that allowed, decentralization to serve communities at the local level. Literally, hundreds of areas that we're in, through all 3 of our channels. I mean, however our originators want to be served, we're working to improve every day to serve them. And I think there's something to be said about that, especially from a privately owned company perspective. Yeah,
built by originators for originators. When I first heard that, I was kind of like, it's just recruiting. That's just recruiting.
Right.
But once I got involved, I was like, it's actually designed this way, and I'm able to grow this thing. It's been amazing how I've been able to have the flexibility to grow this the way I know it needs to be grown. I've been in this business since 24 years almost now. So I mean, I've seen the good, the bad, the ugly of this thing, and so seeing how the growth.
But you were 16, right?
Yeah, absolutely. I was 15. So yeah, but like I said, I appreciate you coming on and bringing a little bit of your knowledge, because I encourage everybody, if you're on LinkedIn, look you up, because just about every day you get a video out, which is amazing on its own. Because if people that do videos will understand, content is not easy to come up with, but the knowledge that you pull out there. And also when you're recording them, will show people the dedication that you guys on the senior level side on this company have, because these videos are coming out at 2 or 3 in the morning which means you've been out there all day long, working into the night, making sure, because you guys are constantly working on these things. And I mean, for a long time, I didn't even know those were windows behind you. I thought that was just a wall because it was always nighttime.
Yeah, right.
In those videos.
Right. Yeah.
So,
there's actually a little quarry back there. So
yeah,
I appreciate you recognizing that, because, since March, we've been in overdrive, and, I don't feel like anyone in our company should rest until we've solved every issue that we need to deal with, no matter what it is. And, it's a loan level, perfection. We're trying to make sure that everyone's happy, and it's hard when there's so much volume going on. So we're staffing up, we're building, we're growing. We think that, chaos is a ladder, and this is something that has, that's a Littlefinger quote from Game of Thrones, just so you know. Chaos is a ladder, and it's been a little chaotic since March. There's more volume than this industry can handle. And we've been able to ladder up and grow, as have most really well-run companies. And what's going to be interesting is when rates do go up and refi business starts to drop down, we're going to hold our ground like we have every time when we staffed up. And we're going to watch all these other companies, that think with the, they have to answer to shareholders or the hedge fund or, the bank. And, they're going to meticulously go through and, cut all their people's salaries and pay and staff. And we don't want to do that. We want to grow. We think that, in a down year, this industry does $1.1 trillion in loans. Next year is supposed to be $2 trillion. We may do 4 this year. We think we can't scratch out a few billion every month. Of course we can. So we're going to hold our ground, and we're going to level up in market share and get back to serving our communities on the local level. And it feels like it's a little less hectic now than even a month ago. Everything just feels like a little more under control, which is good. That means that we're kind of gaining back, that upper hand on everything that's out there. I mean, if we wanted to, we could easily just go out and just crank volume right now. We could put our rate at a level and we just blow it back up again. But I think that a lot of lenders have kind of found like this nice little homeostasis. And so what I will say is that rates, that's probably the biggest caveat to this 50 basis point thing where rates might not go up, is that if volume starts to decrease, lenders can kind of offset the hike in price by kind of working for less, which ultimately that's what every lender is going to be doing anyway. I mean, when the Amazon effect, has at least commoditized the parts of the business that can be commoditized, but they can't commoditize you. They can't be you. They can't be Joe. They can't be local. They can't be right in your neighborhood. They can't be building the community. That's something they can never take back. And if all else is commoditized, then we can literally compete on just the local personalized relationship level. And that's what we want to do. That's the best part about our business. That's why I jumped on with you, man. You and I connected and we bonded over the last couple of years. We share a lot of the same, beliefs, and, we're here to serve. We're just humble servants. I like to have fun doing it. Like to, make each other laugh and have a good time. And,
you got to in this business, and I think a key thing you said before I let you go is just saying we staffed up and we're not planning to do that peak time staffing and wipe them all out and then still
no way
turn times. The bottom line is turn times are slower now across the board for all lenders, but the difference is when things turn back to normal, our turn times are going to be almost unbelievable because of how we are going to have our underwriting staffed up. And that we're not, so we're planning long term because we know this is short term. So we're planning long term by leveraging this. That's the beauty of this thing, and seeing that foresight in that. Because I know I've been in a lot of companies. I've seen them wipe out staff, and then you're right back into the jammed up system because now you're still understaffed, and even though on normal volume. So
well, think about it from an underwriter's perspective. I mean, underwriters right now, they have an opportunity to make good money, but money isn't everything. And I mean, we pay well. We have a bonus plan we rolled out earlier in the summer. We got some feedback from our people and we kind of tweaked it. So we have the ability to pay our underwriters, for well-earned hard work. But beyond that, I think underwriters also want support. They want to know that, you've got a team leader that you can go to that's credible and helps you make a decision, and that there's an underwriting manager behind that team leader, or even a regional underwriting manager, that you have a deal desk and a help desk, that your company is going to support your decisions that you make and not say, how many hours did you work and how many deals did you do per day and how much this, and then every time you make a mistake, because people are making mistakes right now. It's a human business. You're home with children who are distance learning on Zoom and you got to make financial decisions. I mean, you want to know that the company doesn't just hammer you as an underwriter, and then they're building and continuing to build the technology and support behind the underwriter so they can do a better job themselves. We're doing that here. We're investing millions of dollars in our underwriting support infrastructure, both from a technology and human capital standpoint. Not every lender can do that. I mean, you got a lot of small lenders out there like, oh, I'll just pay you more. You're like, okay, and that's short-lived. And ultimately, those companies that don't, take that investment in the underwriting infrastructure, they're going to lose those underwriters to, companies that are, and that's something that we think we're in a very strong position.
Yeah. And I'm seeing a lot of interest now. So as we continue to grow it, but I know, like I said, I don't want to hang you out too long, but I appreciate you coming on and sharing just a smidgen of the knowledge that's in your head on this stuff. And I know you're in high demand for people to interview you, so I'm glad I snuck it in there.
Yeah. Thank you, brother. Good talking to you, and thanks for having me on your show. I appreciate it.
Yeah, man. All right.
We'll do it again.
Definitely.
All right, man. Be good.
All right.